Emma stands on the porch in April 2013, keys in one hand and a stack of moving boxes in the other. She paid $250,000 for a three-bedroom bungalow in a mid-sized Sunbelt city, put 10% down, and locked a 30-year mortgage at about 4.25%. Across town, her friend James is still renting. It's the same job, similar salaries, but James is stubbornly waiting for a correction. He says, "I'll buy when prices come down 15%. Fast forward to March 2021. James finally pulls the trigger and pays $425,000 for a similar house in the same neighborhood, but now mortgage rates are artificially low, barely below 3% for new buyers. Emma, meanwhile, refinanced once, renovated the kitchen, and sold her house in 2018 for $340,000, then bought a bigger place for $475,000. Which of them ends up ahead? Emma, who bought earlier and kept moving, or James, who waited for a dip that never quite happened? Why does one approach consistently win out in a market that keeps going up? At first glance, the story looks like luck, but there's a mechanism under the hood that most people don't actually explain. Housing isn't just an asset class that floats randomly. It's governed by a mix of credit conditions, building supply, demographics, regulation, and human behavior that together create a persistent upward pressure on prices. In plain terms, if you can afford to buy and the supply of houses is tight, prices rise. If borrowing gets cheap, demand surges. If builders can't or won't build enough houses, supply doesn't catch up. Over time, those forces compound, so buying earlier often captures years of price appreciation and structural change. In this video, you'll see 3 concrete reasons housing tends to keep going up, shown through Emma and James's real numbers, real events, think 2013, 2018, 2021 to 22, and a real shock that shows why timing the market is painfully hard. Reason 1. Mortgage rates and leverage make the same income buy much more house. Emma bought in 2013 for $250,000. She put down $25,000, 10%, and financed $225,000 at roughly 4.25% for 30 years. Her initial principal and interest payment was about $106 per month. James waits until 2021 and buys a $425,000 house with 10% down to $42,500 and locks a 30-year rate at about 2.9%. Mortgage rates were historically low through 2020 into 2021. His monthly principal and interest is only about $1,243. Now, that looks higher than Emma's, true, but consider what both of them captured in home price appreciation between 2013 and 2021. Nationally, broad price indexes like Case-Shiller and FHFA show cumulative home price growth in that window on the order of 50 to 80% in many metros. In Emma's neighborhood, her $250,000 bungalow appreciated to $340,000 by 2018, a 36% gain that she realized when she sold. That gain effectively doubled the impact of her original $25,000 down payment. Her equity went from $25,000 to roughly $115,000 after paying down the mortgage and accounting for sales costs. When Emma bought again at $475,000, she rolled that equity into a larger property, increasing her exposure to further appreciation. 2 important lessons from these numbers. First, leverage amplifies returns. A modest down payment becomes a large equity stake if prices rise. Second, low interest rates lower monthly payments relative to price, encouraging buyers to pay more. When the Fed pushed rates down after 2008 and again during 2020, the monthly cost of owning fell, even as nominal prices rose. That created an affordable envelope for buyers. People could take on larger mortgages for the same monthly cash flow. That's how demand moved the price ceiling higher. Buyers weren't just paying more, they were able to pay more because lenders made the monthly math work. But here's where it gets even more interesting. Supply constraints and policy created a persistent shortage that let prices keep drifting up even when demand wobbled. By 2013, the U.S. construction industry was still recovering from the 2008 bust. Single-family housing starts collapsed to roughly 300,000 to 400,000 at the bottom, then recovered slowly. Through the 2010s and into 2020, annual single-family starts often hovered around 800,000 to 1,000,000, below historical averages relative to household formation. Add zoning rules in many cities that limit density, skilled labor shortages for construction, rising material costs, and local resistance to new builds. NIMBYism. Those frictions meant supply didn't flex quickly when demand rose. In Emma's city, new completions were constrained. The county approved fewer new single-family lots in 2016 to 2019 than it did a decade earlier. The result? A tightening market where buyers competed for a limited pool of homes. Now, bring in the 2020 to 21 shock. Mortgage rates dropped again to near all-time lows. 30-year rates fell to around 2.7% in late 2020, while pandemic patterns shifted demand towards suburban and Sunbelt markets. Suddenly, buyers who could work remotely wanted more space. Prices surged. James, who had been waiting for prices to fall, found himself in a bidding environment where offers frequently exceeded asking price. Anecdotally and in the data, multiple offer situations and all-cash bids increased. Institutional investors also stepped in to buy single-family homes in some markets, and iBuying firms temporarily raised floor prices. In many places, the market never corrected by the 15% James wanted to see. Instead, prices climbed, and James paid $425,000, much more than Emma's original purchase, because what he was waiting for never materialized. The supply-side story explains why that happens. When it's expensive or difficult to build new homes, demand shocks translate into sustained price increases rather than quick corrections. Another beat, then rates spike, and one person reacts differently. In 2022, mortgage rates surged from the low 3% range to roughly 6 to 7% as inflation rose and the Federal Reserve tightened policy. That was the plot twist. Monthly payments for new buyers jumped dramatically. James, who purchased in 2021, felt pressure on his budget as refinance windows closed and his monthly payment became a larger share of income. Emma, by contrast, had more options. Because she bought earlier, refinanced at low rates in 2018, and sold once to buy up, she had built both equity and a payment cushion. When rates spiked, Emma decided to stay put and rent out a spare room if needed. She also had the option to sell into a seller's market if she wanted to lock gains. James faced higher carrying costs if he tried to move. And because he bought closer to the market peak in his neighborhood, his immediate equity cushion was thinner. This twist shows that timing matters less than the structural forces and choices around leverage, liquidity, and flexibility. A named example, after the 2013 to 2021 run-up, some markets like Phoenix and Boise saw prices triple in less than a decade. When rates rose in 2022, those markets cooled, but not a full reversal. Instead, many saw price plateaus or modest declines, 5 to 10% in some places, not the sharp 15 to 30% crashes of 2008. Why? Because household formation, limited supply, and wage growth kept the floor under prices. In other words, even when rates pulled some buyers out, the supply-demand mismatch still prevented a full collapse. Now the payoff nobody expects. Housing gains compound through repeated decisions, not just one-time price moves. Emma didn't just benefit from buying early. She made a sequence of choices, refinancing, renovating, timing a sale in 2018, and buying up. That multiplied her wealth. Let's look at the numbers to close the loop. Emma's path. 2013 purchase, $250,000, 10% down, $25,000. By 2018, she sold for $340,000. After paying off remaining mortgage principal, let's say she owed $200,000, closing costs and taxes, approximately 6%. Her net proceeds were about $116,000, turning her original $25,000 into $116,000 in 5 years. She used that as a down payment to buy a $475,000 house in 2018 with 20% down, financed the rest at 3.5% after refinancing, and did a $30,000 kitchen reno that pushed comps up. By 2023, her $475,000 home appreciated to $620,000 in that market. Her mortgage balance had dropped to about $410,000, so she had roughly $210,000 in equity. James's path, rented until 2021, then bought $425,000 with 10% down, $42,500. He financed $382,500 at 2.9%. By 2023, prices were mixed. Let's say his house rose to $460,000. After 2 years of payments, his balance is still around $370,000, and closing costs or transaction friction mean his net equity is about $90,000. His gain looks modest compared with Emma's $210,000. Even though James bought in a low-rate period and paid a higher nominal price than Emma did in 2013, he missed the compounding that came from Emma's earlier ownership, the refinance at a reasonable rate, and the intermediate sale that let her step up to a higher-priced home with more leverage working in her favor. 3 deeper takeaways emerge. First, housing appreciation is not uniform, but structural forces, credit availability, persistent supply constraints, and demographic demand create a long-term upward bias in many markets. Second, leverage magnifies outcomes. A small early down payment can convert into outsized equity if prices rise and you control the asset. Third, sequence matters. Buying early, building equity, and redeploying it into larger assets can produce compounding returns that waiting for the perfect price rarely does. Okay, practical takeaway. If you're watching Emma and James and asking what to do, think in terms of alternatives, not perfect timing. Ask, can you afford the monthly payment? Do you have an emergency fund to handle rate shocks? Is your local housing supply constrained? If the answers are yes, buying earlier gives you a seat at the table for appreciation, tax treatment, and forced savings through mortgage amortization. If you choose to wait, recognize the cost. You may miss years of compounding and face higher prices later. That doesn't mean rush to buy in every market. Local fundamentals matter. Check supply metrics, building permits, vacancy rates, job growth, and rent versus buy math for your area. For Emma, the practical rule was, buy when payments are manageable and you have a plan to capture equity, maintain, renovate, or hold. Refinance opportunistically and consider selling to buy up if your equity can meaningfully increase your next purchase. For James, the lesson was costly but instructive. Waiting for a hypothetical correction without a clear exit plan often results in lost opportunity. If you prefer to wait, hedge the risk by saving more, locking a lower rate via a float-down clause if available, or targeting markets where supply dynamics could flip. The housing market keeps going up not because of magic, but because of repeated ordinary forces, cheap credit, limited new supply, shifting demand, and the way leverage turns small early moves into large long-term advantages. Emma's story shows how sequence and action compound. James's shows how patience without a plan can be expensive. Your move should be a plan, not a prayer. The housing market keeps going up because cheap credit, constrained supply, shifting demand, and leverage amplify small early moves into large long-term gains. And whether you benefit comes down to timing, a clear plan, and how you manage risk. If you found this useful, subscribe. New video every week.